If you try to recollect the previous lecture, we had discussed 4 methods of revenue recognition. One was the cash method of revenue recognition. Then we discussed about a straight accrual method. Then the third one was completed contract method. And finally, the last one was percentage completion contract method of revenue recognition. So, these are the 4 most widely used revenue recognition method. Now, out of these 4, in most of the country you will find that the last one, that is the percentage completion contract method of revenue recognition, is practiced. So, using this principle of revenue recognition, we are trying to analyze the contract status report. You may be knowing that the different projects which a construction company undertakes, they start at different point of time. For example, one project may be starting in the month of January, another could start in the month of March, right. Now, when you try to analyze these projects at a given point of time, maybe at the end of 31st March, you will find that different projects may be under different stages of completion. Some project may be completed by 50%, some of them may be completed by 60%, 75%, 80%, maybe 100%. So, if you try to analyze the different projects of a given construction company, you will find that they may be at a different stages of completion. So, using these figures, we are trying to analyze the status of the different contracts. So, for that we will start with a small example. For that, we assume that there is a project XYZ and its contract value is 1000 rupees, or it could be dollar, whatever it is. Now, in the same project, the cost to date that has been incurred is 450,000. So, we are given the contract value, we are given the cost to date that has been incurred. We are also aware of the fact that the total amount that has been billed to date is 700,000. That means, this is the amount for which bills have already been submitted to the owner. We are talking of a single project right now. Now, the planner of this particular project has estimated the cost to complete the balance work, and it is estimated to be 400,000. That means, whatever amount of work that is balanced, whatever amount of work that is balanced, it has been estimated to cost at 400,000. So, you will find that the total current estimated cost will become the sum of 450,000, which is the cost to date which has already been incurred, plus 400,000. So, what you find here is that the estimated total cost right now for the project is 850,000. So, with these two figures, that is 850,000 and the cost to date, we can calculate the percentage completion. Remember, the formula which we are using right now is cost to date divided by total estimated cost. So, cost to date was, for our example, it was, I will show you how we have calculated. Cost to date was, cost to date for this example project is 450,000, and the total cost to date which is estimated. So, estimated total cost to date is equal to 850,000. So, the percentage completion of this contract is 450,000 divided by 850,000, and you will get a figure of 52.94%. Now, using this percentage figure, we can calculate how much revenue has been realized for this particular project. If you remember the formula, revenue is given as percentage completion multiplied by contract value. Which happens to be 0.5294 in terms of decimal multiplied by 1,000 rupees. So, you will find this to be equal to 529,400 rupees. So, this is as far as revenue is concerned for this particular project as on date. This very small and simple example we have taken. Yes? Doesn't matter, you can see these data, I will repeat it again. Okay. See, we have taken one small example in which we are given the following data. If you look at this particular slide, name of the project given as XYZ, contract value is given to be 1,000,000, cost to date that has been worked out is 450,000, total amount billed to date is given to be 700,000. The estimated cost to complete the balance work is 400,000. So, how much will be the total estimated cost as of now? It would be equal to 450,000 plus 400,000. So, you can see a figure of 850,000. So, now two information you have got, cost to date and the total likely cost of the project. So, using these two figures and the formula that we discussed in previous lecture, we can calculate the percentage completion of the project or the contract. Now, that calculation is shown here. If you look at this, cost to date is 450,000, estimated total cost is 850,000. So, percentage completion becomes 450,000 divided by 850,000, which is equal to 52.94%. Now, using this percentage completion value, if you multiply this with the total contract value, you will know how much revenue has been realized as far as this particular project is concerned. So, it is a simple mathematics. You find that the revenue for this project using percentage completion contract method is 529,400 rupees. Right? Now, what we do from here onwards is we try to forecast our estimated profit or loss at this point of time. Now, if you look at this, it is shown in this particular slide. Total profit that would be recognized at this particular point of time would be equal to 79,410. This you get it from the product of 52.94% and 150,000. From where we are getting 150,000? Because you said the contract value is 1,000,000 and the total estimated cost is 850,000. So, my total expected profit is going to be 150,000 that multiplied by 52.94% is going to be 79,410. Now, using this value we can also calculate whether the overbilling is there in this particular contract or underbilling is there. Now, overbilling you can calculate it by the formula bill to date minus revenue. Now, bill to date for this particular project is given to be 700,000 and revenue is given to be 529,400. So, what you get in this case is, this is a simple case of overbilling and its value is 170,600 rupees. We can also calculate the contract balance. This again is very simple to calculate. You know the contract value and you know how much billing has been done to date. So, 1,000,000 is the contract value and 700,000 is the billed value. So, the difference is 300,000, that is the contract balance. Now, you can follow the similar process to work out this particular example. In this particular example, I have taken 5 projects which are under execution by a contracting firm. For each of the project, I will read out the contract value and the cost to date as well as the total amount billed to date and the estimated cost to complete the balance work, and finally, you can calculate the current estimated total cost. So, as far as the problem is concerned, you are given the information up to column 5. Now, for first project which is school 1, the contract value is 1,000,000, cost to date is 450,000 and total amount billed to date is 700,000 and estimated cost to complete the balance work is 400,000. For second project which is school 2 building, contract value is again 1,000,000, cost to date is 450,000, total amount billed to date is 400,000 and estimated cost to complete the balance work is 400,000. In store 1 building, the contract value is again same 1,000,000 and cost to date is 450,000, total amount billed to date is 600,000, estimated cost to complete the balance work is 500,000. Again, for another project which is that of store 2 construction, contract value is 1,000,000, cost to date is 450,000, total amount billed to date is 450,000 and estimated cost to complete the balance work is 460,000. Finally, the last project, that is of hospital construction, contract value is again 1,000,000, cost to date is 475,000, total amount billed to date is 525,000, estimated cost to complete the balance work is 575,000. So, whatever process we have discussed just now, you can apply those processes for calculating the contract status for these 5 projects which are being executed by a given construction company. So, this is as far as the first topic of today's lecture was concerned, that was how to prepare the contract status report. So, I will just summarize you how actually we go about it. For this, number of persons are responsible, your accountants, your planning engineer, your top management of the construction company, all these people they try to generate such report which is essentially the estimate of the likely cost at completion, and from the physical records you know how much cost you have incurred. Based on these two data you calculate how much percentage completion has been achieved as on that particular date, and then you can calculate how much revenue has been generated out of that particular project. So, based on this revenue and the percentage completion, you know whether you are making profit or loss as far as that particular contract is concerned. And then you can analyze some other details also, for example, whether there is a case of overbilling, underbilling, and what is the balance status of contract. All such informations can be derived once you have collected the data required and which was shown in initial slides. Now we move on to next topic, which is the formal accounting systems, in which we will see what is cash book, what are journals, and what are ledgers. Some of these terminologies were discussed briefly in our previous lectures. For example, we discussed what is cash book, we also discussed what is journal. Of course, ledgers part we did not discuss in too much detail, but just to summarize you what cash book means, basically it records all the transactions involving cash. So, we define two types of transactions, one which involves cash and other which does not involve cash. So, non-cash transactions. So, cash book transactions are recorded in cash transactions are recorded in cash books, whereas non-cash transactions are recorded in journal. Now, cash book, at any point of time we will be able to know what is our cash balance. That is another advantage besides recording the cash transactions in a chronological order. So, what cash book essentially contains? It keeps record of all the cash transactions in a chronological manner. Besides this, at any point of time I would like to know my status of cash, whether I am having cash balance, that also is given by our cash book. Then coming to journals, all non-cash transactions are recorded in journal first, and then subsequently they are transferred to different relevant books such as ledgers. Now, hello MOE? Yeah. Did you miss substantial portion? You were able to hear us?
No. Yeah, you can continue.
Okay. So, we were discussing about the ledgers, journals as well as cash books. Now, the sequence for accounting process was discussed in the previous lecture. We defined it as a 7-step process, starting with initiation of transactions, then recording of those transactions in a chronological manner, then taking into consideration certain adjustment entries, recording transactions in T accounts. How to record transactions in T accounts was not discussed in detail in previous lecture, that we will see in today's class. Then the fifth step is to prepare the initial trial balance. Finally, we prepare the profit and loss account and close the T accounts. T accounts are also known as ledgers. And finally, all these 6 steps leads us to the preparation of the balance sheet. So, these processes are followed in a formal accounting process. If you try to recollect, in the previous lecture, we tried to prepare the balance sheet and profit and loss account after every transaction. That was just to illustrate you the concept, how with each and every transaction your balance sheet gets affected. And other purpose of following that process was to show you how a balance sheet is always kept balanced. For example, if you remember few transactions of previous lecture which I will show you. For example, if you see the first transaction, on August 1st, David put in rupees 50,000 cash as capital and persuaded his wife to give an interest-free cash loan of rupees 75,000. Now, after this transaction, if you try to prepare the balance sheet in an informal manner, in your asset part, you will show the cash equal to 50,000.